In September of 2008, the United States Treasury and the Federal Reserve began a series of emergency actions that would place hundreds of billions of dollars behind private financial institutions. Some markets had already stopped functioning. Others were hours away from doing so. The scale of intervention was unprecedented in peacetime. At the time, much of the public discussion focused on visible failures, individual banks, specific trades, isolated excesses. Less visible was how long the system had been moving toward that point, and how ordinary the process had appeared while it was happening. The conditions that made the crisis possible were not introduced suddenly. They accumulated over more than a decade, during a period marked by relative macroeconomic calm. From the mid-1990s through the early 2000s, inflation remained subdued, growth was steady, and financial volatility declined across asset classes. Central banks, particularly the Federal Reserve, interpreted this environment as evidence that policy frameworks were working as intended. Market participants reached a similar conclusion. Stability became a baseline assumption rather than a temporary state. Within that context, financial innovation accelerated. Advances in computing power, data availability, and quantitative modeling made it possible to analyze and price risk in increasingly granular ways. Mortgage lending, once a localized and relationship-driven activity, was transformed into a national and then global market. Loans could be originated, pooled, sliced, and sold to investors who never interacted with the borrower or the property. This was presented not as risk creation, but as risk distribution. The underlying belief was that diversification, when applied broadly enough, could reduce exposure to any single failure. If individual mortgages defaulted, the losses would be absorbed across large portfolios. If regional housing markets weakened, national exposure would remain balanced. This logic was embedded in models, ratings methodologies, and regulatory capital rules. It did not require optimism about housing prices forever rising. It required only that declines would be uncorrelated and manageable. At the institutional level, incentives aligned with this framework. Banks earned fees by originating and structuring loans. Investment firms earned fees by packaging and selling securities. Rating agencies earned fees by evaluating them. Each participant operated within its own mandate, relying on standardized assessments of risk produced elsewhere in the system. Responsibility was distributed in a way that made coordination unnecessary and scrutiny diffuse. Housing itself appeared to justify confidence. In many advanced economies, residential real estate had not experienced a nationwide decline in modern times. Price movements were typically local and driven by employment trends or supply constraints. National data showed modest volatility. Even when prices softened, losses were usually absorbed through refinancing or time. For policymakers, housing was viewed as a stabilizing asset class tied to household balance sheets and consumption. Following the recession of the early 2000s, monetary policy remained accommodative. Interest rates were lowered aggressively and kept low for an extended period. This reduced borrowing costs across the economy and made credit more accessible. Adjustable-rate mortgages, interest-only loans, and other non-traditional products expanded the pool of eligible borrowers. These instruments were justified as bridges to ownership in a period of stable growth and rising incomes. As lending standards loosened, mortgage volume increased. The quality of individual loans became less central than the volume and speed of origination. Verification practices changed. In some cases, income and assets were stated rather than documented. This was not hidden, it was formalized. The assumption was that property appreciation would compensate for borrower risk, and that securitization would distribute any remaining exposure. Investors searching for yield found structured mortgage products attractive. Government bond yields were low, and traditional fixed-income instruments offered limited returns. Mortgage-backed securities and their more complex derivatives promised higher yields with ratings that suggested low risk. For institutional investors constrained by mandates, the ratings mattered more than the underlying structure. A security rated AAA was treated as functionally equivalent to a sovereign bond, regardless of its internal composition. Risk management systems reflected the same assumptions. Models were calibrated using historical data from periods of relative stability. Correlations between defaults were assumed to be low. Liquidity was assumed to be available in most market conditions. Stress scenarios existed, but they were bounded by precedent. Extreme outcomes were assigned negligible probabilities, not because they were impossible, but because they had not been observed. Within firms, leverage increased gradually. Balance sheets expanded, often through short-term funding markets that appeared deep and reliable. Repo agreements, commercial paper, and other wholesale instruments provided cheap financing. As long as asset prices remained stable and counterparties remained confident, these arrangements functioned smoothly. Their fragility was not evident in normal conditions. Regulators observed these developments with limited alarm. Oversight was fragmented across agencies with different mandates and perspectives. Capital requirements were often tied to ratings and internal models, reinforcing existing assumptions. Innovation outpaced regulation, but this was interpreted as efficiency rather than vulnerability. Markets were believed to be self-correcting, and intervention was seen as potentially distorting. Dissenting views existed, but they were not central. Some analysts questioned the sustainability of housing price growth. Others warned about leverage or complexity. These concerns were often addressed within the same frameworks that generated them. If risks increased, spreads would widen. If spreads widened, behavior would adjust. The system was expected to signal its own limits. The first signs of strain did not initially contradict this belief. In 2006 and 2007, housing prices in certain regions began to plateau and then decline. Delinquencies increased, particularly among subprime borrowers. Losses appeared contained. Structured products absorbed initial defaults as designed. Markets adjusted prices but continued to function. For many participants, this confirmed that the system was resilient. The turning point was not a single default or announcement, but a shift in perception. As losses accumulated, correlations began to rise. Declines in housing prices were no longer regional. They were synchronized. The assumptions embedded in models became less credible. Securities that were supposed to behave independently began to move together. Liquidity, once assumed, became conditional. Confidence in valuations weakened. Market participants questioned whether prices reflected fundamental value or temporary dislocation. In the absence of clear benchmarks, trading slowed. Some markets effectively froze. Institutions that relied on short-term funding faced increasing scrutiny from counterparties. Haircuts increased. Rollovers became uncertain. What had been a stable funding structure turned into a source of pressure. These developments unfolded unevenly. Some firms adjusted early, reducing exposure and raising capital. Others maintained positions, expecting conditions to normalize. Diverging interpretations reflected differing incentives and constraints. Selling assets into illiquid markets meant realizing losses and signaling weakness. Holding them required confidence in both valuation and funding. Neither option was clearly preferable. As pressures intensified, the interconnectedness of the system became more apparent. Losses in one area affected balance sheets elsewhere. Uncertainty about exposure led to generalized caution. Institutions reduced lending not only to manage risk, but to preserve liquidity. This behavior was rational at the firm level and destabilizing at the system level. Public authorities responded incrementally. Liquidity facilities were expanded. Interest rates were adjusted. These measures addressed symptoms but did not immediately restore confidence. The complexity of exposures made it difficult to assess solvency. Market participants did not know which institutions were sound and which were not. In that environment, caution dominated. The failure or forced merger of individual firms marked visible milestones. but they were expressions of underlying conditions rather than causes. Each intervention altered expectations about future support, sometimes stabilizing markets, sometimes raising new questions. Decisions were made under time pressure and incomplete information. The objective was not to preserve existing structures, but to prevent disorderly collapse. By the time large-scale guarantees and capital injections were deployed, the crisis was already systemic. The quiet assumptions that had accumulated over years were being unwound rapidly. Models were revised, ratings were downgraded, practices that had been standard were reassessed. The adjustment was abrupt because the buildup had been gradual. In the years that followed, narratives simplified. Responsibility was assigned to specific actors or instruments. Complexity was reduced to slogans. While these accounts captured elements of truth, they often obscured the more structural features of the episode. The crisis did not arise from a single error or innovation, but from a convergence of reasonable decisions made within a shared framework. That framework emphasized efficiency, diversification, and market discipline. It assumed that risks could be measured, priced, and distributed in ways that made them manageable. It relied on historical patterns to bound future outcomes. When those patterns changed, the system lacked clear mechanisms for adjustment. The financial system did not collapse entirely. It adapted through intervention, consolidation, and reform. Some structures were dismantled, others were reinforced. New rules were introduced to address leverage, liquidity, and transparency. These changes altered behavior, but they did not eliminate uncertainty. What remains notable is how little of the crisis felt inevitable in advance. The signals were present, but they were interpreted through prevailing assumptions. Stability bred confidence, and confidence shaped decisions. The most consequential risks were not hidden, but normalized. The buildup was quiet because it occurred in familiar processes: lending, investing, modeling, regulating, carried out by institutions following established incentives. There was no singular moment when the trajectory became clear. Only in retrospect did the connections appear linear. The system adjusted, as it often does, through a combination of market reaction and public intervention. What proved harder to resolve was the tension between complexity and comprehension. The crisis exposed not only financial vulnerabilities, but limits in how risk was understood and communicated. Those limits did not announce themselves loudly. They accumulated steadily, in plain sight.